Thank you, everyone. That was awesome. So I think they had some sugar, too. That was quite lively. We're going to go ahead and do what I like to do is one of our data slides. And I want to introduce the CEO of Jywire, David Stoss, someone who's been working with us for a number of years, and we're delighted to have him here. And he has some great data to share with us. So, David.
Thanks, Mark. So real quick on Jywire, we're all about location advertising. We're the leader in location advertising on any connected device, a smartphone, a tablet, or a laptop. We do this over both mobile, through mobile apps. We do it over public Wi-Fi. And the key thing is we're able to do it at scale so we can attract a lot of large national brands. On a monthly basis, we connect to about 50 million unique mobile consumers. We've done this over about 400 million unique devices with billions of location data points. And so we're always very interested in everything going on about location. As part of our focus on that, we do a lot of research. Because we're always really curious about what is a mobile consumer doing, how is location changing their behaviors. We want to understand that so we can help our brands and our partners understand that. And so this is some of our latest research. We talked to about 800 mobile consumers just this past month, focused on taking pictures. And Mark asked if we'd be willing to share some of this with you today. So how many people take a picture with their smartphone? Yeah, pretty much everybody. So it's not surprising that people do that. What is surprising is that 72% said they use their smartphone or their tablet as their primary device for taking photos. That's their primary device. And what's amazing about these devices is there's a location component to it. Now, these people are taking a lot of pictures, 5 or more a week, but 67% are location tagging their pictures. So this form of media is now really becoming locationized. It's becoming location media. And the reasons behind this are kind of interesting, not just the fact that they're doing it, but the drivers behind it. I thought this was interesting. 31% just want to remember where they took their picture. 33%, though, they want to use it to notify family or friends. So that social aspect, the reason we're here today about SoLoMo, really comes into play when we talk about taking pictures. Not surprisingly, men and women have different behaviors. Men are more interested in tagging their photos to notify people in the immediate vicinity, such as, hey, I'm out at a bar, I'm watching the U.S. Open, I want to let my friends know who are nearby, come join me. Women, on the other hand, want to location tag their photos to communicate with a broader network, their family and friends, not necessarily in the immediate vicinity, but just their social network in general. Parents are also a different demographic. Sure, parents take a lot of pictures of their kids. I have 3 kids. I take pictures all the time. 91% take pictures on the go. But what I thought was fascinating here is that parents are 20% more likely to location tag their photos. And that's, again, going out to sharing all of this with their network of family and friends from a social perspective. So some pretty interesting data just when we drill into one little piece of the mobile experience, one function that you can do with your connected device. Taking a picture has now become a form of location. And it really shows as part of a broader trend, which is that consumers are becoming very location savvy. Everything they're doing is becoming location aware, and location is becoming a feature, if not a driving force behind why people use different things on their mobile devices. Brands need to understand this, developers need to understand this, because location is at the heart of what's changing our behaviors. Now, what's also behind this is it's not just about a location, it's about a location and an audience. Understanding location gets pretty interesting, but when you look at the differences here between men and women and parents and the drivers and how people use this, understanding an audience in mobile with a location to be able to deliver the right content experience or the right advertising message becomes really key, and that's where all of this is heading. If you guys are interested in any more of this data, we have a wealth of it. You can go to our website, jywire.com. It's under a section called Insights. We also have a table outside. Feel free to stop by and we can answer any of your questions. Thanks.
Okay. No. Okay, we're in the second. We've got a panel of VCs, and we're going to talk a little bit about the space from an investment perspective. So if panel, come on out. We're going to try and divide the time roughly half and half. We're going to talk first specifically around social location, and then we'll shift and talk generally about investing in general. So guys all look comfortable. It's kind of like The View, just not as good looking. So except for you, Indy. So we'll let you start. Introduce yourself, and we'll go from there.
Are you guys able to hear me okay? Sounds like it. So my name's Indy Guha. I work for Bain Capital Ventures. We are a early stage focused venture firm, mostly Series A and Series B investments. And part of why we're excited about the conversation today is we really like to help startups work with big brands, big retailers, kind of the Fortune 2000. It's a huge part of how we try to help our portfolio companies. So looking forward to the conversation.
Good. Great, thanks. Dave? I'm going to walk over here, don't I?
Sure. Dave McClure, partner at 500 Startups, generally cause trouble whenever I can, and occasionally invest in a few companies.
Most recently in Japan. How are things in Japan?
Things in Japan are going actually pretty well. There's an app called Line, which is kind of a combination instant messaging and lightweight social networking service that has about 40 million users. That's kind of the latest interesting thing there. That's actually 20 million in Japan, outside Japan.
Cool. John?
John Malloy. I'm a partner at Blue Run Ventures. If you forget everything I say today, just remember I'm the mobile guy. My second job is to make sure that Dave doesn't get into trouble.
Hopefully that'll come into handy. So we're here talking about social location. So why don't you go down and sort of vote up and down. You like the space? Do you not like the space? If you like the space, what do you like about it? If you don't like it and think it's overhyped, why?
We were all talking backstage, and we had this amazing brainwave that mobile was going to be huge someday. So yes, I definitely like the space a lot. I think there's a couple of pieces missing, and maybe we can circle back on that before you're really going to get big brands excited about really moving their advertising budgets to some of these channels.
So which investments do you guys have in this space that you broadly characterize social location?
Sure. So, a couple that come to mind, Stamped in New York. It's a way for you to express your interest graph in the real world. Blip.me here in the Bay Area, which is about, think of it as democratizing radio and being able to share experiences using your smartphone and using audio.
INRIX you guys are in INRIX on the location side. And am I right that you were in where?
We weren't in where. We
Sorry,
are
never mind.
INRIX and Skyhook on
Skyhook,
the location side.
Sorry, Kev.
And so I think, one interesting question is, what are other really unique data assets you can build to kind of unlock the value of what people are doing with their smartphones?
Cool.
How could you use retail inventory, local inventory, and purchase intent and marry that on a mobile device?
So Dave, out of 500 startups, some have got to be in social location. There's like a big Catholic Italian family.
You're assuming I actually know which ones they are.
I just don't know what their names are.
Yeah, well, in many cases I may not either. John and I are in food spotting together, so that's certainly one business that's in that area.
Food spotting's here.
I guess I sort of take issue with the way that we're defining the space.
Okay. You have a 25% vote here.
Yeah, social platforms and social networks. Yeah, I guess that's interesting. Location-based services is a technology, not necessarily, business model, and I think that's usually the problem. Investing in mobile is kind of like investing in air. Like, we invest in mobile, yes. We invest in people who walk around on two legs. So that's extremely not specific. And I would probably say it's more interesting to talk about the customer, not the technology or medium itself.
Okay. So location, you're just saying, is part of the infrastructure, not so interesting.
I think the challenge with location is usually it just tells me where I am. It doesn't necessarily connect me to transactions. So
cool.
The theoretical way that's interesting is local advertising and or local merchants and point of sale. Mm-hmm. But if you're just doing the location technology and you're not connecting with any of those other pieces, then you're probably a business in search of a business model.
So let's come back to that point. But John, you guys have invested in several companies in this space.
So in order of appearance in the show, I would say we're investors in Some, who was here, Banjo, who was here, and I only caught part of that controversial panel, but heard Wind, it went okay.
Yeah.
And then Waze this morning. I'm kind of with Dave, which is really scary. We rarely agree on things. I really am a mobile investor, and it's not as common as air. I think it is sort of next generation computing platform. I'm really interested in mobile-first services, meaning services where your initial experience, your entire experience lives in the mobile device. That's what I'm interested in. And when I think of social and local, they're the two most important elements often in those types of services, but I don't wake up in the morning and say, hey, let's do a social local advertisement deal today. Let's do a social local, social network that finds my dog. I don't think of it in those terms. I think of it in terms of what are the elements, what's unique about the elements, and what is this business actually going to build for itself that's defensible over time.
And so what are you betting on? Because one of the things we've been talking about here is kind of the interconnection between, although we've widely derided the social local label, that and brand advertisers, things that people are going to advertise around. And Dave, you brought up the third part, which is, the users and that kind of thing. Are you looking for primarily user experience, and then it may use some of those elements as it goes, or how do you think about it? What works?
What I always look for the most, and what I care about is data. And so what you're learning, how you're leveraging, I look at the phone as a box of sensors, and what are the sensors, what are you deriving from that, and what's the sort of extracted layer, data layer that you're actually going to, it's inuring to that business. Typically typically location is an important element of that. Social, for me, is a means of more easily acquiring users and more easily continuing to stay in dialogue with users.
But as people are building on these big platforms, the platforms also want that data. And so they keep moving up the bar of what data they're collecting and what they're pulling in versus what they're letting people build on top of. So how do you, is this goodness or badness? Because it's easy, it's great distribution, but also they keep moving their bar up on what data they're going to own. What do you guys?
I would actually say most of the mobile platform providers have crappy analytics, if any, whatsoever. And maybe they'll get better over time, but typically there's more opportunity there, not less. We're investors in Appsolar, which is a company that provides analytics and behavior for around mobile. Flurry and other providers have great big opportunities, even though they're not necessarily running the platforms themselves. And I think probably somebody had brought this up before. I think if you're talking about moving kind of traditional advertising spend over to mobile, you probably do want to have access to a lot of analytics, particularly not just analytics around the mobile platform itself, but the overall customer view, like what time are they spending, in various screens and technologies, and so that they know how they're adjusting behavior across each of those devices, which is currently pretty damn hard. So. There's a lot of opportunity in that area. I guess if I lean to the left, I'd sound more. But I think my major challenge with this, mostly because we're a smaller fund, is we can't get too visionary on what people are trying to build. That usually involves pretty significant CapEx spending, and John may be able to do that, and other bigger folks may be able to do that, but we need to probably see connection to revenue pretty quickly, within a year or two, ideally, when we invest. Or at least if that story is well developed. I think challenges with things like Foursquare, as much as I can appreciate they've built a really big story, it's still very, very challenging to get distribution to a large network of small merchants and build a business there. And so while check-ins are theoretically very valuable, until you're actually getting paid by someone for the exchange of consumer information who wants to know about it on a local level, it's only a theoretical business model, not an actual one.
So you're looking for a much more provable business model in what's a relatively short time frame from an investing standpoint.
It's more a function of just our fund strategy. Other people can take and go after more risk, but I prefer to see that someone is paying for check-ins before I invest in somebody who's creating an app that generates check-ins.
Indy, how are you looking at it?
I think, so I really agree with the perspective that you got to find kind of a path to monetization. I guess the way we define that is, are you enabling a behavior that consumers enjoy and do today on their mobile device? Because that increases the odds of your success of getting adoption. But I think on the other side, we care a lot about solving a problem that is hard to solve and where there's a lot of value to optimization. So what does all that mean? Something like 70% of shoppers with smartphones will use their phone to find a local merchant, to find what's close to them. There's a huge opportunity there to influence somebody's purchase. Think of it as the equivalent of what Google did 12 years ago with search online, right? But there's a couple of pieces of infrastructure that are missing. What is the inventory in stock near me right now if there's something I'm searching for. I'd say that's one piece. What is the ability of a brand or a merchant to deliver a message to me in that moment when I'm searching for a product? And if you can kind of connect all those pieces, you have the opportunity to build a huge business and drive a lot of ROI for all the pieces of the ecosystem.
But that sounds like you're really drilling down into the actual transaction. You're trying to get pretty close to the transaction on that.
That's certainly one unsolved area for mobile that a lot of people care about, and I don't think we're there yet. And to the point of data, I think a lot of the infrastructure exists. Nobody's figured out a way to stitch it together into a seamless path for driving transactions.
So when you look, I guess the part that I'm hearing is on one hand, you're saying we're looking for a user behavior that people like. So in other words, if I could make something all these people would start doing 4 times a day, that would be interesting. But that may be something that they do 4 times a day that I have no earthly clue how I'm ever going to make money out of. And then that doesn't pass the Dave test.
It's because I'm a more short horizon investor. Longer horizon investor who has more capital probably can take that risk over a 3 to 5 year time frame.
Can I sell you on that, John?
I take that risk every day.
You take so distribution first, monetization later.
Of course.
Yeah. And that's just basically difference in sort of the portfolio.
Different philosophy of investing.
We do a lot of stuff together, but I definitely take a longer-term view. I'm looking to build significant companies over time, and the way you do that is by owning as much of your own destiny as you possibly can. And that, to me, that's about understanding your user, whether it's a business or whether it's a consumer, and it's deriving something that is unique to that business. So the best example I can give you is Waze. When I invested in Waze, who I know that for those of you who were here this morning, I think Diane spoke this morning, when I invested in Waze, it was literally one founder. There were technically 2 founders, maybe 3, depending on how committed they were at the time, but it was literally an open source initiative in Israel. But what was happening was the community was starting to build maps. And being a bit of a map geek, I will admit that, I was excited about that, which they had no idea that they had found a kindred spirit in that score. But what I saw was an opportunity to actually create something that I knew was really, really expensive to actually build. Maps cost a lot of money. It costs literally hundreds of millions of dollars just to keep a map current in the United States every year. So the fact that you could suddenly get people to do it for free, I saw, okay, that's data that I understand. Now it's grown way beyond that. Now many layers have been built on top of that. But what I look for is, are you deriving something that's really unique, that's going to be unique to that company?
So you sort of touched on this, but one of the things characteristic of social and location is there are big platforms out there that will get you a lot of distribution fast on either of those. I mean, there are big map platforms, one added last week, and they're big social channels. So when you look at that, it seems to me there's a good news part of that, cheap distribution and things like that. There's maybe also a bad news part of that. What's the bad news part of that? Or how do you look? Are there bad news parts of that?
Hell yeah. Do you want to go first?
Well, I think the bad news is if the access to distribution is controlled in a way that's not a level playing field. So one, if that's the only path to distribution, that can be challenging. Facebook's been both a benevolent and occasionally idiosyncratic dictator at times in giving distribution and access to people. Apple certainly is that way.
Someone made the comment that every time Apple releases a new version of iOS, 25 business models implode. I'm not sure if that's true or not, but they suck more stuff into the iOS every time.
Or you could turn that around and say every country that Apple opens a new app store in is a huge platform and opportunity, and China's like fantastically large opportunity. No, I don't think they're really stomping on business models that much. I think they're just more, they don't really have a clearly repeatable path to distribution that's based on either organic or paid avenues right now. It's mostly editorial. And so trying to get distribution on the Apple platform is mainly this jockeying contest for the top 10 to 100 positions in whatever app category you're trying to go after. The equivalent of SEO or SEM for mobile would be awesome if that were made more clear.
How to do that?
Tapjoy and Chomp were sort of going after that.
Yeah.
Apple acquired Chomp and slapped down Tapjoy. So, mobile distribution, paid or organic, is still a really interesting place to go after. Probably even more so in the long run on Android than on Apple. On social platforms, I think it's a little bit more wide open. We'll see.
I want to go on a little bit to, actually, screw it, I'll go on right now. Let's talk a little bit more of the broader perspective. One of the big things in the news, obviously, has been the Facebook IPO, a lot of interesting noise around that, around the effect it has on the capital markets. I think Paul Graham, either inadvertently or maybe it got taken out of context, sent out something that was sort of construed as the rest in peace take two version to the people in Y Combinator. What's the impact of the Facebook IPO, just in general, on the market? What do you think that's going to do?
To which part of the?
Well, they're good. What Paul Graham said is tough times coming, pressure on valuations. It also strikes me they're going to be a whole bunch of more people entering the early stage angel rounds. Perhaps a Facebook mafia will now compete with the various other mafiosos. What do you see happening?
Facebook's at 31.41 right now.
31.41.
I think for entrepreneurs out there, I think don't believe what you read. Everyone always overreacts, and Paul probably overreacted too.
I'm not. In fairness to him, I'm not sure he intended it to be as cataclysmic as.
Also, I think he said there might be.
Yeah.
He said there definitely was.
Look, if you're an entrepreneur, you're down to the ground, you're working hard, you're focused on something that's going to be important in years. The clouds shifting above you aren't really getting down to you. I think it does have an impact, at least immediately. Certainly there's an impact. Probably the people that are impacted most are venture capitalists or limited partners who invest in venture capitalist firms who are waiting on multi-billion-dollar exits, people that gambled on late-stage deals at high valuations. There's a trickle-down effect. You're luckily down in an area that's relatively safe. And the fact that there's going to be more money available for you to raise your initial round, that's all positive. Obviously, just raising that initial round is not just what it's about, and you're certainly impacted by everybody up the ecosystem. But I don't think that the Facebook IPO really impacts entrepreneurs. It has an impact on the value chain, obviously.
Is there too much money in the really early stage right now, do you think?
No, I think that that's just a lot of hooey that's spread by incumbent, ornery old VCs, which I am not one. I'm sick of hearing that.
Hot damn, I agree with that.
So not too much money in the early stage.
There may be too much dumb money. There is not too much money. There are plenty of businesses to be built on the dramatically growing and dramatically increasing in monetization consumer audience and small business audience that is growing like weeds internationally. And even domestically, the business is increasing because we're adding people who are old and young, and like these devices are coming into the hands of everyone. So like it's a huge fucking playing field. Yeah. And like anybody who says that,
wow, 20 minutes.
Oh, sorry.
20 minutes.
I mean, it's just like there's a lot more deal flow coming at later stage, larger VCs, and they should be happy about that. If they're like whining about that, then tough shit. Yeah. But they probably need to hire about 4 more, associates or analysts to look at all the deal flow coming at them. They should be able to filter for higher quality.
Yeah, I'll jump in here. I totally agree. I think the part that gets unhealthy is if a lot of larger VC funds, call it 400, 500 million plus, start getting really busy at the seed stage. I think that's best left to the people that really specialize in the seed stage, spend a lot of time in it, and are able to figure out how to support those companies and really bring them to market, help them scale.
So what do you think about scouts? About a month ago, there was a lot about scouts and some of the big companies doing scouts. Good, bad, indifferent?
I think it's pretty unhealthy, particularly if at some point it does become transparent where the money came from. Fundamentally, if a larger VC firm writes 20 to 30 seed checks a year, it makes zero difference to their fund returns if they do none of those investments, but it really hurts those entrepreneurs.
I think it's really great validation that Sequoia has finally come around to seeing that spray and pray investing is the status quo, and I welcome them to the market.
In those cases, do the entrepreneurs know where that money's coming from? It wasn't clear to me that was true in all cases.
That's probably the only concern. I think as long as the entrepreneur
doesn't know, there's some guy sitting there and you don't know that he might be a pipeline.
The entrepreneur wants to keep it quiet and the VC wants to keep it quiet.
In defense, since my friend I saw his clip at TechCrunch on this. I'll defend Roloff, who's an old friend and an entrepreneur that I backed.
I used to
before.
work with Roloff.
He identified, I know, but I'm going to stick up for him. That's why I told you I was going to keep you in line. I don't think I think that was all made up by the media. I think that
Wait a second. It wasn't made up by the media.
I understand the checks were signed. The checks came in from Sequoia. You knew they were coming in. There weren't people that were misled as to where the money was coming from. If you misled somebody, then give me an example. But otherwise, don't make accusations.
But I heard of entrepreneurs who were surprised to see people in their cap table right before they were getting ready to close.
All right. Specifics, man.
But it does point out, I mean, this kind of problem of companies with large amounts of money wanting to invest in early stage, not really knowing how to access this. What is sort of the fundamental economics at early stage? Because, I mean, so Dave, let me pick on you. Average work year is about 2,000 hours. You spend half your time doing other stuff.
Maybe
that
for
would be 1,000 hours divided by 500 startups. I get 2 hours of your time a year. What do you tell me in your 2 hours?
So first of all, that's not the way that we look at the time frame. So
imagine my surprise.
Yeah. Well, I mean, I sit on 5 boards out of 300 companies.
So you actually
probably
spend a lot.
5 is too many.
Yeah.
But we have an investment team of 5 partners. We have about 100 mentors, actually probably 150 that are somewhat involved with our portfolio. We have probably 500 or 600 founders in over 300 companies. So the overall network of people that are looking at sourcing, helping us mentor and advise companies is easily 500 people.
So it's multiplied by that.
Not all full-time people. And I wouldn't even pitch the individual hours per day as like the resource that we're trying to provide to people. We're trying to provide a set of, scalable resources around mentoring, around design and usability, around access to platforms and relationships. These days, more access to international distribution. Obviously, we are not going to be able to provide individual attention at, 8 hours a day for, every one of those companies.
Yeah.
And at the same time, we're really looking for probably 20 companies out of 200 that really hit escape velocity that we're going to be doing follow-on investments in.
That you're going to spend more of your time with.
We'll spend more of our money with.
Yeah.
So our model is about spending more time with the company, so that's why we like to work with Dave.
Yeah.
So he's somebody that I've known a long time. We'll vet companies, but if we invest, he knows that we're going to try to build a significant company in that category. So for me, I just have to pick my spots very, very carefully because I'm going to be in it for a long time. So that's, and that's kind of our model.
And your time ends up becoming kind of the scarce commodity, right, in the end? Is that a fair statement?
But that's why, our current fund is $240 million. I think that I like the model of $200 to $300 million as sort of for early stage venture capital. I don't think you need more than that.
Yeah, I think that's probably the more significant difference, not so much between what John and I are doing in investment, but like there's a set of companies that I think are going after, billion-dollar stories that are hopefully CapEx intensive, that's from the investment standpoint, not necessarily from them needing that. And then there's a set of companies that I think are a little bit more nimble, probably quicker to revenue, and are more capital efficient on building the basic prototype and getting to market. And those stories, may choose to raise a lot of money because they're doing customer acquisition, financing on equity, although that, may change in the future as well. But I think there's different types of plays where a lot of the activity in the market for exits is happening probably south of $100 million, certainly south of $250 million.
Yeah.
And there's really substantial businesses that can be built, on a fairly small amount of capital, maybe between 2 to 10 million in capital. SlideShare was a business that raised all of $3.5 million in capital, was sold to LinkedIn for $120 million.
Not bad deal.
It took them 5 years.
Yeah.
But I would say that they were very frugal about the way that they raised and allocated capital, and as a result, the founders probably own 60% of the business.
I'm getting the end flag. I'm going to ignore it if people have a couple of really good questions. Sorry. Any questions from the audience out there? And wave your hand around, do motion or something.
I think there's a microphone up front.
Okay, if not, I'm going to ask one more question. Are there any questions out there? Okay.
Don't feel pressured.
Don't feel pressured. Yeah, the real good got them, I think. Just number one mistake you see entrepreneurs making as you go out. What is the number one thing people coming in to get funding and venture capital from you? What is sort of the number one mistake you see most often?
Probably just not getting to market fast enough and focusing on too many types of customers. Those are probably two sides of the same coin, I think. Traditional advice from VC, larger VC, is think bigger, go after larger markets. My advice is always think smaller, identify more niche-focused consumers or businesses that you're targeting, and understand your customer base in very microscopic detail if possible.
John or Indy, any thoughts on that?
It's always hard. You always ask these negatives, which my brain does not work that way. It's why I do what I do. I think me too. So I think to the extent that the biggest turnoff for me is if you're coming in and you're aping the last three things that were out there.
I just read it last week on TechCrunch, so here I am pitching you.
Yeah, that's crazy. Like I don't need the VC speak of, or the name drop of the 4 business models du jour. That's a massive turnoff. I mean, you have to typically have been hard at it for a long time, and you really know your stuff, and you're going a slightly different direction, because I'm looking for something pretty big, and if there's already a category and a buzzword, it's too late for me.
Too late. Cool. Eddie.
Yeah, it's going to sound familiar. Don't try to be X for Y, like open table for blank, Groupon for Y. That pretty much means you're a derivative of something else. We get excited about unique ideas, unique problems. I guess related to that, if you've really thought about the problem you're trying to solve and what you're passionate about, that's going to come across when you talk to us. So there's really no need to kind of create this grand vision just to get investors jazzed. If they're smart about the space you're in, they'll get jazzed anyway. And I guess the third piece is don't raise too much, or really be thoughtful about what you need to build a winning company, or at least get to your next set of milestones. There's a lot of downsides that come with trying to raise too much capital just because the markets might support it, because now you're answerable to that extra capital.
Good. I've got a bunch more questions. If you could stand up here, you could see I'm getting the hairy eyeball from 3 directions that I'm running over time. So with that, I will thank our panelists, ask you to do the same, and we'll move on to the last panel of the day.